Anyways, good morning, y'all. This is recorded, so if people come in, I'm gonna just continue because it will be recorded. Um, but welcome back to another trading room session. The last session we talked about, what did we talk about? We talked about building our bias, our daily bias. Starting from the higher time frames and figuring out what direction price is going and what side we're leaning on. Just basically just having a plan before we actually get into a trade. But today we're going to talk about something that also goes hand in hand because, like I said, everything we're doing is based on those three pillars. And mindset or psychology is included in all of them. But as I was saying, today we're going to talk about risk management because, as we all know, you can have the best setup in the world. We see all A+ setups all the time. We can call a trade out good all the time. Like, we can do all that great stuff. We can have the best entry, everything, or we can think we have the best entry and everything. But if we don't know how much we're actually risking when we enter these trades, all of that stuff, it doesn't matter. It's just noise. But if you don't know how much you're risking, that's what we're going to go over today. So from this point forward, you'll have a number and you can use that number to your advantage when it comes to these trades. Because as y'all know, zones and all that are different sizes. But having that number in mind, you'll kind of know, okay, boom, this is how much I'm risking. So I'm going to keep it simple as always, or at least try my best to keep it simple. I've been trying to make it make sense in the best way possible because it can be complicated for no reason. And I'm a person that likes simplicity. So if I get off track or if it gets too complicated, let me know. I feel like I broke it down pretty simple. So I'll ask if anyone has questions at the end. And if not, we'll just get straight into our chart. So like I said, we're going to be talking about risk management, ticks, and all of that, basically finding our number. And by the end of all of this, we should be able to calculate our risk, have our number before we enter a trade. So let's start with the first one. What is a tick? I feel like it's kind of the easiest part. But a tick is just the smallest price movement that a contract makes. So we trade M&Q. So for M&Q, one tick is 0.25 points. So me personally, easiest way for me to say it is it's worth 25 cents. But I don't want to confuse y'all. So I'm going to leave it at points. M&Q, one move, when M&Q moves, it moves 0.25 points. And that one tick, when it moves 0.25, is worth 50 cents. So if M&Q moves 4 ticks, that's 1 full point. And that 1 point is worth $2. That's it. That's all. I'm going to say it just like that, and I'm going to leave it right there just like that. I'm not going to make it any more complicated. So, again, a tick is just a measurement. Just a tick is just how they measure price movement in the market. So, I know for like gold, or is it micro gold, whatever, one tick is 10 cents or 0.10 points. And then one full point of gold is worth $1 or $10. No, $1. It depends. It's either mini or the micro. One of them is worth 10, the other one is worth $1. So is it $1? See, that's why I'm not even gonna get complicated. We're gonna stick to M&Q. Not even trying to throw nobody off. But so when I'm looking at a chart and I'm saying, oh, I'm risking 20 points, you would convert those points into ticks, and then you would convert those ticks into dollars. And that's how we get our number. So how do we do that? So let's say I have a trade and my stop loss, or my if you use the position tool and your points, the distance from your entry and your stop loss is 10 points, right? We got to figure out first, how many ticks is that? So if we know 4 ticks is 1 point, that means we'll calculate 10 points times our 4 normal ticks. That's 40 ticks. So there's 40 ticks in 10 points because 10 points times 4 is 40 ticks. All right, I hope everybody's keeping up with that. Now, how much is 40 ticks worth in M and Q? Because it's different for each instrument. So for M and Q, each tick, one tick, so a 0.25 move is worth 50 cents. So 40 times that 50 cents is $20. So if I'm trading M and Q, one contract, and my stop loss is 10 points, that means I'm risking $20. That's before all the fees and all this thing, they got to take their money. But that means I'm risking $20 for that 10 points. Now, when you want to change your contract over here, if you want to change your contracts, one contract, so if you enter and you're risking a 1-to-1, that's $20, one contract. If you do 2 contracts, a 1-to-2, that's $40. 3 contracts, it's $60. All you're doing is adding another 20 every contract, because it's $20 for one contract. That's how you find your number. And mind you, the chart never changed. Your entry didn't change. Your stop didn't change. The only thing that changed was how many contracts you added. And this is why they talk about your position size mattering. As if you go into the trade and you're like, oh, I want to aim for a 1-to-5, but you only got $50 in your account, baby, you risking more than your account size. So that's why it's good to know your number. So now let's talk about your stop, because this is where I think one of the places I was confused at first before I finally understood like my number. I don't feel like your stop should just be like, oh, today I just want to lose $20, so let me put my stop at $20. I don't think that's right. I think your setup, however your setup look on a chart, your setup should tell you where your trade goes wrong. So, for example, with the checklist that I use, we know our zone is our stop. And y'all know we seen zones as big as 8 points and as big as 200 points. The zone size will always change. So let's say we got into a buy and the entry is, we enter at $20,000. And based on our setup, the price dropped to like, they dropped 10 points. I know after it drops 10 points, my stop loss is hit, my trade is invalid. Or not invalid, my trade is wrong. Because it done hit a 10-point stop. So that's going to be about, because we just did the 10 right here. We know 10 points is $20 for one contract. So that means that trade was a $20 loss. But if I put in three contracts in that same trade, same entry, same everything, now I'm risking $60. The only thing that changed was my position size. And that's the part I really think I want everybody to understand, because your position size is what you adjust to fit your risk. So, for example, if you know your number is 50, let's say $50 is 50 points is $200, right? You might get into a zone and the zone is only 10 points. If your account can, because you have to have the capital, if your account can, you can easily put in 2 contracts, because you know that's only $40. And overall, you know 200 is your number or 50 is your number. If it's only 10 points, you can really put in multiple contract size because that's still within your number, which is still within your account size. You just have to be able to make sure your capital matches the number that you're choosing, and you're not just choosing a number just because you want to catch a bigger trade, which leads me to make sure your position size fits your risk. Because let's say you needed a 20-point stop and you're telling yourself, well, no, I only want to lose, like you have a 20-point stop loss, but you're telling yourself, oh, but I only want to lose $20. Like, I don't want to lose no more than $20. And so that you make your stop loss only 5 points because that equals $20. But now the trade ends up stopping you out just to turn around. It's still within the zone, so the zone was still valid, the trade was still valid, but you lost $20 for no reason. You could have let the trade play out and continue, and you could have been in profit, but now you're down $20 because you didn't let the trade breathe, or you didn't let price breathe. You didn't use your zone anymore. So technically you're not managing risk, because I mean, yeah, you say you only want to lose the $20, but that trade was still valid because of the zone. If anything, the best thing you could have did was just pick a better entry or waited for a better entry rather than trying to squeeze yourself in a trade and not giving it space to breathe or things like that. Or you're just trying to make it just look nice. But at the same time, price is not being able to like move the way it's supposed to within your setup, because you only want to lose $20. So the zone is $20. The zone is 20 points, but you make it 5 points. That's not. It seems like it's managing risk on the outside, but in reality, it's not. It's not managing risk. And that's usually where we go wrong in trades, because we hop in, we hop out, we hop in, we hop out. But that zone is literally telling us, hey, this is where price is going to could retrace back to. You have this amount of space to work with. Find an entry within here. Once it goes past here, the trade is now invalid. Instead of using that to your advantage, you're saying, oh, I'm gonna jump in here and I'm only gonna, I don't want it to go past these 5 points. That's not managing risk. It sounds good because you only lost $20, but at the same time, you didn't have to lose that $20. You could have found a better entry, or that could have just not been your trade. Either or. So putting it all together, because this is the process I really want us to understand, is first we need to find our setup. Then asking, okay, cool, if this trade goes wrong, where would it be wrong at? And because of the way I have this checklist set up, the zone tells us where the trade goes wrong. That's where the trade is invalid. Then how far is your stop loss from where you potentially are entering? You will know how many points and ticks that is. It usually tells you. And then how much does that equal in dollars amount? So that's when you calculate how much you're risking. But if you know your number, you would already have that number in mind. And then decide how many contracts, or your position side, like how many contracts make sense for this trade. And then you execute. So you don't just start off with like, oh, how much do I want to make? I don't even think we have time to think how much we want to make. If anything, we have more time to think about, okay, how many points is the zone before we can think about all of that when price is moving before it comes back to the zone. Okay, this zone is this big. Y'all hear me say that. Oh, this zone is this big. I bring out my tool. I see how big it is. In my head, I'm already calculating, because I keep my calculator up. I already know how much this is for one contract, things of that sort. Is it within my number? All of that. I'm looking at all of that before I'm even thinking like, oh, okay, how much can I make? Because I'll know that based on the chart. I may say, oh, I think price can get to here. That might be a 1 to 3. Or I don't even want to do all that. Let me just stick to a 1 to 1. It's the same. The 1 to 1 is the same, which let's get into that. So now that we know how to calculate, our ticks, now we can get into our risk reward. So basically, when you see the RR, that is your risk to reward. So you hear people say like, "Oh, I'm up, a 1 to 2 risk reward. I'm up 1 to 3, whatever, all that fun, great stuff, right? That is just your risk to reward. So let's again say I'm willing to risk the $20 that we had. So a 1-to-1 is $20. But if I added if I made that a 1-to-2, that would be $40 for that same one contract. If I made it a 1-to-3, that'll be $60 for that same one contract, and so on and so forth. So when we talk about like risk to reward, we're basically saying how much am I risking versus how much am I making or trying to make, because price don't have to hit the 1-to-3. Price could just hit the 1-to-1 and turn around, right? And that's where you hear people, I'm not going to get into that. So not every trade needs to be a 1-to-10, and because that's not the point. Can it? Absolutely. But as long as we can at minimum aim for a 1-to-1, you're fine. But the whole point is knowing your risk and whether the reward makes sense for that risk. Because what you don't want is to just be in a trade, you're risking $100, but you only left with $50. Granted, okay, cool, yeah, I made $50, but you put in $100 just to make 50. If anything, for a good 1-to-1, you want to put in 100 to at least make 100. Same with the 1-to-2. You want to put in 100 and make 200. You don't want to just put in and make $7. You don't want to put in 100 and you make $20. You want to at least get out what you put in. And again, so that's the point of knowing your risk. And I'm going to keep it that simple because it's not that complicated. It only gets complicated once you start adding the contracts and all that fun stuff. But yeah. So, this challenge, for example, I think now is the best time to really try to focus on learning these numbers and applying it and stuff like that. Because as your account gets bigger, obviously the number is going to get bigger. The risk is going to get bigger. But we have a small account challenge. So the temptation is to think, I need to risk more because I need to grow this account faster. We're not doing that. You can, because I don't fund nobody's account. But a small account doesn't mean you have to take a bigger risk. It actually means you just need more discipline. You need to regulate that let me stop. Let me gotta get into that. Need to regulate that nervous system, I'm telling you. Because let's say you have $500 and you're risking $250 trying to double it. That's not a plan. You should not be risking 50% of your account. People do that. Absolutely. They fund their account. If you fund your account and you want to risk 50%, go right ahead. But is that good risk management? It's not. It is a risk, but it's not good risk management. So the goal isn't to turn our 500 into 5,000 tomorrow. Our goal is to be able to stay in this game, stay in this challenge, stay in this for a long period of time, long enough to become the trader who can manage a 5K account. Because if you can blow 500 in a day, you'll blow 5K in a day. So the longer you can stay in the game, manage your risk, you'll eventually get your K to 5K. You can apply that same discipline to your 5K account, so on and so forth. That's the difference. We're just trying to, with the small account challenge, we're just trying to build the skill first and then the money follows. Instead of trying to focus on the 5K, the 10K, we're building the skills to become the person that can manage a 5K account, manage a 10K account live. So before we get into a trade, I think today I want, if we can, in the chat, I want us to try to do the numbers, find our own personal number that we can stick to. So then when we get into these markets and we see these zone sizes and stuff like that, we can already have an idea. We should be asking ourselves, where are we entering? Where is our stop loss? How many ticks am I risking? How much is that going to cost me? And eventually, and if everything goes well, where am I getting out at? Like, where's my reward at? Like, is it a 1-1, 1-2, 1-3, stuff like that? Because if we don't know these things, then we shouldn't even be in a trade yet. And I don't know if you guys noticed, but we do that when we are entering the trade. We see how big our zone is. We see where our entry is. We set up our stop loss and our 1-1. So we do these things. If you're just hopping in a trade, I'm pretty sure you're not doing those things. Because hopping in, you probably don't know your stop loss. You probably just getting out when price look funny, and you're probably hopping in when price look good, and hopping out when just because. So I'm pretty sure if you're just hopping in and out, you're not doing those things. But hopefully after today, we change that. Because I know, me personally, I don't want to lose $20. I barely want to lose $50, but we're trading. So, yeah, I think I don't really want to make it any complicated than it needs to be. If you don't take anything away from this, the only thing I want you to take is just, I don't want us going forward to be surprised by our loss. When we do lose, I don't want us to be surprised by our losses. If our number is $100, if our number is $200, we shouldn't be surprised when a trade is down 100 or down 200. That's our number. Once it goes over that and we're still in it, that's when we should kind of reconsider ourselves, not the trade, ourselves, because that means we should have got out, because that is our number. And we're practicing risk management. We need to be deciding our number before we enter any trade.